Hello, friends. Welcome to my lecture on REIT. This is the second lecture in the series of REIT. In this lecture, I intend to share the differences between investing in physical real estate versus REIT. In the first lecture, I had shared the high level overview of REIT as an asset class. I had explained the different components of REIT returns, and I had also done a comparative analysis between investing in REIT versus S&P 500. I compared the historical performance between S&P 500 and REIT. In this lecture, I will just focus on sharing the key differences between physical real estate and REIT. So the first difference is that when you an investor is investing into a physical real estate, he or she is having a direct ownership of the property. On the other hand, when an investor is investing into a REIT, that what investor is basically gaining access is just a share of the REIT company, which in turn will own and manages the underlying property. So when an investor is investing in REIT, the investor is not having a direct ownership of the underlying property. This is something the investor has to keep in mind. In terms of the exposure, yes, the investor still has exposure to the underlying property. If the underlying property prices increase, the REIT shares is also likely to increase. And similarly, if the rental prices of the underlying properties will increase, the REIT manager most likely will pass on as increased distribution to the investors. The second key difference is that when an investor is investing into physical real estate, it entails additional charges like stamp duty and maintenance charges. Now, this additional expenses is quite significant for physical property, and it eats away the returns from the investment. While investing in a REIT, it doesn't entail additional expenses like stamp duty, so investor uh, has more returns to enjoy in while investing in the REIT. Now, on the maintenance charges, although investor don't pay maintenance charges directly in case of REIT, but indirectly, the REIT will typically outsource the maintenance and operations to a third party, and those charges will be part of your net operating income. So ultimately, investors are indirectly paying for the maintenance charges as well for the REIT. The next key difference is that when an investor invests into physical real estate, the liquidity is pretty low. While in case of REIT, the investor enjoy very high liquidity. Now, this is one of the key benefits of investing in a REIT, because the investor can buy and sell shares in a REIT just like investing in stocks in the open market. While in case of physical real estate, it might take even years to dispose of a physical property. The next key difference is that when an investor is investing into a physical real estate, and if that, let's say, the property is not rented out, investor don't gain any property income. While in case of a REIT, because the underlying is a pool of property and not just a single property, so let's say even a single property is not rented out, still the investors and gets to enjoy distributions because some part of the property is still rented out. Now, for any strong REIT, typically the occupancy rates are typically more than 95%. So an investor who invests in a strong REIT with a very strong sponsor can expect continued distributions over the years. And the last key difference is that where for investing in physical real estate, it requires a lot of money. That is, it's a large ticket size item. While in case of REIT, even a small investor with less disposable income or money to invest can still go and buy REIT shares. Even with $100 or $200, an investor can still buy REIT shares. But in case of physical real estate, it's typically hundreds of thousands of dollars in some country, and in some country it can be millions of dollars just to buy a single property. So that's all I had for this lecture. I hope you enjoyed this lecture. I'll see you next in the next lecture. Please consider liking this video, and if you enjoy such content, please subscribe to my channel. Thank you.